initially, it might be it might seem like a daunting task because 10Ks are typically hundreds of pages long, and so you may find it a little difficult to get into this process of reading 10Ks. But as with any other craft, with practice, it becomes a lot easier over time. Important things in 10Ks will just sort of jump out at you.
Hey everybody, welcome back to the show. This is Hora, Stalker CEO and founder, and today I am sharing with you a pre-recorded episode that I recorded a few weeks ago with a very special guest. You may know him from Twitter. His handle on Twitter is 10K Diver and is one of the most loved and followed Twitter personalities in the financial or the so-called FinTwit space. 10K Diver is a computer scientist. He has almost no formal training in finance investing, which is a surprise if you look at the quality of his content and the depth of the knowledge he has about investing in finance. He's passionately curious about these subjects, and he's been following his curiosity for many years now to learn investing from Warren Buffett writings, several books on the subject, YouTube videos, podcasts, etc. 10K Diver's goal is to help many people, as many investors and retail investors as possible, to learn these complex financial and investing topics in a simple way without all of the jargons. To that end, he has a Twitter account, as I told you, at 10K Diver, which is followed by many people, as I told you, more than 100,000 followers on Twitter and rapidly growing. And he has a social podcast as well via the call-in app called Money Concept that he uses to share and simplify these complex financial investing topics to their basic and easy to understand fundamentals. And with this goal of helping each other and every other retail investors and individual investors out there, he's been able to help many investors like you and I in their pursuit of better investment decisions. I hope you enjoyed this pre-recorded episode. And without further ado, let's just jump in. The very first question I want to get into today is that what is the story behind 10K Diver? Why did you come up with this name? And what's sort of like the story that our stock guardians would probably love to understand? What is the background there?
So I'm a computer scientist. I don't have any formal training in finance or investing or anything like that. But as I was growing up, my dad, who does a lot of things in investing, he inculcated in me the importance of saving and investing and prudent money management in general. And so when I came over to the US, I got some of those ideas with me. And for since about 2011 or something like that, I have been trying to learn the fundamentals of finance and investing sort of on my own because I don't have any formal training in these areas. And I've been lurking on Twitter for quite a while now, actually. And so Twitter is this huge social network, and there are many sort of sub components of Twitter. There is politics Twitter, and then there's FinTwit, the finance Twitter. Then there are Twitter accounts devoted to sports and so on. And as I was lurking on Twitter, I started noticing that the FinTwit community was becoming something very special over time. There were lots of very accomplished investors. They were sharing all kinds of very valuable insights and so on. They were forming very deep, meaningful relationships. And I felt that with my background, which is not in finance or investing, I could contribute because I could help people understand the fundamentals without getting too much into the jargon or something like that. In a simple way, using simple language and simple examples, I could help people understand the fundamental concepts. And so that's why I started this Twitter account. And when I started the account, I was searching for a name. So one important thing when you're looking for a name is first the website URL has to be available, because I'm not interested in paying someone $100,000 to acquire the rights to a website or something like that. Then there are the name has to be short, it has to be easy to remember, and so on. And it also helps if the name shows up at the top of various alphabetical rankings and things like that. So if you had a name that started with a number 1, that uh, that might meet some of these requirements. And so since I like reading 10Ks, I thought 10K Diver might be a good name. And so I started my Twitter account under this name.
Wow, I love it. And it's just the amount of foresight you've had in just choosing the name is mind-boggling. And I got to tell you a little story before we jump into the rest of the thing. So when we started the stock cards, we were only focusing on our stocks. That's why the company called Stock Card. And then when we started expanding to ETFs, then we were thinking about, okay, now should we do ETF cards or not, or is it under a stock card? We decided to do stay a stock card. And now we're expanding. So not so secret, but we're expanding to crypto and we want to launch crypto cards. But I was checking cryptocard.io and cryptocard.com. And then just like you said, somebody wants a couple of $1,000s to just sell that to us. And I'm like, I should have had that foresight early on to kind of like have this thing that is just comprehensive, but it's, I should have had you as a consultant when we started the company and ask you, how do we name this thing? And, what URL do we need to buy? Anyway,
but I had a little bit of help from Brad Stone's wonderful book about Amazon. So when Jeff Bezos was trying to find a name for Amazon, the story goes that initially he was thinking about names that involved books because Amazon was a bookseller. But even then, he didn't want to limit himself to just books. And so he chose a name that was generic, the longest river in the world or something like that. And so that can apply to selling virtually any product. So when you choose a name, one of the important things is you shouldn't box yourself too much into a corner. And yeah.
Yeah.
So I had this insight from Jeff Bezos.
Oh, that's awesome. And what is the book called? Do you remember the name? We got to put it in.
I think it's called The Everything Store.
Oh, Everything Store. Oh, it's on my to-do list to read. That's super cool. Everything Store. I wrote it down and then we'll put a link to it in the show notes and things like that for the stock audience to basically have an access to. But that's good. That's a little bit of like off of the main path of this podcast or this YouTube conversation. But yeah, I really love that you did have that foresight. It speaks to your quality as an investor, your quality of your thought process as an investor. You have this foresight of like looking at it in the long term. So I really love that story.
Thank you very much.
Yeah, and that's why we have you on this podcast. It is this YouTube. Well, so let's talk about 10Ks. Obviously, if for our audience and for people who are watching, if they don't know what 10K is, maybe we want to do a quick introduction to what 10K is. And then maybe we dig into why did you even start reading 10Ks? What is the importance of 10K, reading 10Ks, and have the ability of reading through 10Ks? And why not just like use other tools that have summarizing all this information for him? Why does an investor need to have the ability to be able to read 10Ks?
Right. So the first part of that question is what is a 10K? So every publicly traded company in the US has to file certain documents with the SEC every year and every quarter and so on. So every year, every publicly traded company has to file this document called 10K with the SEC. And the 10K is basically an annual report. It will contain a lot of information about what happened in that business over the last year, what its financials were, how much money it made, and what were its cash flows and earnings, and how much it had in assets, and so on. It will also contain some general information about the company, like what it does, what are the products it develops, and how it manages its worldwide operations, if it has those, and things like that. So a 10K is something like a one-stop shop for a lot of information about the company. And I belong to the school of thought that if you invest in a company, you should at least know what it's doing and you should know some basic information about it. And a 10K is sort of one place to get all that information fairly easily. Now, it's true that there are lots of other tools to get that information. But there is something to be said for going straight to the horse's mouth. So when you want to get some information, go to the fundamental source, the root source of the information, and get it from there, rather than relying on other people to sort of read this information and summarize it for you in a way that you may or may not quite agree with. So it's important to be able to read 10Ks. Just for that reason, to be able to get the information from the horse's mouth. And also cultivating the ability to read 10Ks quickly. So initially, it might be, it might seem like a daunting task because 10Ks are typically hundreds of pages long. And so you may find it a little difficult to get into this process of reading 10Ks. But as with any other craft, with practice, it becomes a lot easier over time. Important things in 10Ks will just sort of jump out at you. And this process of reading 10Ks and reading not just the financial statements, but the little notes to the financial statements at the end, you will find all kinds of nuggets in a 10K that you typically don't find in many other sources like analyst reports about the company and things like that. So that's why people should read 10Ks before investing in companies.
Yeah, I love it. Even though a stock card is one of the services that a stock card offer in our platform is basically summarizing the information that is available on 10K. But I absolutely agree with you. The investor needs to have the ability to know where to get the data, and no platform can provide all the information you want. And sometimes you get some information maybe from a stock card or Yahoo Finance or whoever, or analysts and things like that. But then you want to look at it on a historical basis, you need to be able to compare it, or maybe you want to verify it. And I think just digesting 10K and understanding how the companies present themselves, it's as one of those must-have abilities for investors to gain. And even if they choose to use any other tool later on to collect their information, the ability to knowing where this information coming from and how to read it, I think it's fundamental to good investors' success. So
right, absolutely. So stock card is a great tool. I really like using it. And there are a few other tools that I use as well. And they're all great to get a quick summary of the company. But before one actually goes and invests into a company, I think it's a good idea to read the 10K. So you can use the summary as a way to sort of shortlist companies to decide which 10Ks to read and so on. But before actually making the step to investing in a company, it's a good idea to go and read the source documents.
I agree with you. And I, even as a founder of a stock card, I sometimes go to read 10Ks, especially after I verify, like I get an idea and verify some things, then I really want to put a big amount of money in a company, I'll certainly go and take it, like verify some of this stuff on 10K, or like the presentations the company actually add to their investor relations website. So, I mean, let's just jump into a little bit more detail, because we want to kind of like make it more as practical as possible for people who are watching. As you said, 10K documents have several sections, and some of them comes to hundreds of pages. So that at the beginning, it may feel a little bit more sort of not frustrating, but like intimidating. I guess that's the word I'm looking for. Intimidating to look at these documents. So from your point of view, if you want to simplify it to the one piece of information or one section of information on 10Ks that you would say it's the must go to, what is that one section and why? And then right after that, we want to jump in to kind of do some examples so that people can actually really understand it. But let's focus, what is that one place that you always go to and why?
Right. So 10Ks typically have 4 or 5 important sections. One is the description of the business. The second one is the risk factors. Then some 10Ks have information about the directors and officers of the company and things like that. Then there are the financial statements and the notes to the financial statements. Then there's typically a section where the management of the company discusses the financial statements. So there are all these different sections in the 10K, and each serves an important role. But if you gave me a 10K and told me you're allowed to read only one section in this 10K, which one will you read? I think I will pick the financial statements. Simply because I'm more familiar with numbers. I'm a numbers guy, and talk is cheap, but numbers are hard to
manipulate.
well
Yeah.
it's so numbers are much more solid to me, so I would probably pick the financial statements as the must read section of a 10K, although this is a very difficult choice.
Right, it is a difficult choice, but also you're right, like the summaries and the sections that they have text, they can fluff it up, right? And we've seen it we can talk about it later on, like we've seen companies. Actually, let me step back. A couple of years ago, I was a judge at this program in the school that I did my MBA, and I was a judge, and the program was people like master students would do research on different topics related to a disclosure by public companies. And there was this one particular research that I clearly remember reading through it and was very fascinated by. Was this guy was comparing positive words and negative words in the 10K disclosures or 10K document with if the companies who were bankrupt or there was fraud in them. So let's say it took like Enron and then looked at the very last few 10K documents that they published, and then trying to figure out whether the tone of the text has changed over the course of quarters as they get closer, or annual basically reports closer to that event of fraud, when the fraud came out, right? And then it went repeated for bankruptcies and all other like negative stuff from its stocks. And what it realized is that you would not see any negative indicators that this company is going to go bankrupt or this company going to go there's a fraud issue in there until the announcement. Even the one last announcement, like official document that they're publishing before the event of a fraud or event of like bankruptcy, it was still a positive tone. So when I was saying at the beginning that you could fluff it up so well, but you probably, if you go through the numbers, you would see like that the revenue is going down or the margin is going or debt is going, like you would see those indicators, but the tone, the words and verbs were all positive until the last event, which was the actual event.
Right.
So
it's all sunshine and rainbows up until the steep fall from the cliff.
Exactly. So that's why I think you made a really, really good choice to just jump into actual numbers. Harder to fluff it up.
Right, exactly. So there's this guy called Howard Schillit. He's written this wonderful book called Financial Shenanigans, where he takes some of these companies, Enron and WorldCom and other companies that later turned out to be frauds, basically, and he shows how some of these companies fudge their financials, and how you can, if you have a good eye for the numbers, you can actually see through this sort of information by going through just the financial statements in the 10K.
Oh, nice. Financial shenanigans. We've got to add that
right.
to the book list. That's super cool. Awesome. Well, that's a good segue into getting us started to asking you to just kind of like walk us through one example of the financial section on the 10K of your choice. And I'm going to make you a host because I believe we're recording on Zoom and you may not be a host here, but I'm going to make you a host. And then as I do that, what is the company that you would want to use as an example to show us that financial segment or section of the 10K?
So I'd like to use Home Depot as an example. It's a large, well-known public company, and probably if a lot of us in the US, we've been inside a Home Depot and so on. I'd like to use Home Depot as an example to illustrate a few concepts that you can get just by reading the financial statements section of the 10K.
I think that's a really good choice. Let's do it. It's one of the only companies that we've been able to compete with Amazon and not go down with the rise of Amazon. So it's definitely a really good example to take a look at.
Right. They're one of the very few retailers who have been able to stand toe to toe against Amazon.
Yeah, exactly.
So am I the host now? Can I share content?
Yes, you're the host. Go ahead.
Okay, perfect. Okay, so this is Home Depot's 10K, and this is the latest 10K that they put out, and it's got about 83 pages or something like that. And so if I just pull up an overview of all these pages, these are all the various things in the 10K, and so we are going to be looking at only one section of the 10K. So that's going to be the financial statements. So that begins on page number 43 over here. So this is essentially Home Depot's balance sheet, which is one of the key financial statements of the company. So one thing I like to do when I look at a 10K is to first figure out, okay, how much capital does a company need to conduct its operations, and how much money does the company earn on that capital every year. So this is something that's very, very fundamental about a company. How much money does it need to, how much assets and other resources does it need to have, and how much does it earn on those assets. So if you look at Home Depot's 10K over here, it's got about $70.5 billion in assets. If you just follow what I'm circling over here, it's got about $70.5 billion in total assets. So that's how much Home Depot needs to conduct its operations, say. But of course, all these assets, they don't come from the owners of Home Depot. So typically what happens is there are three different sources of capital that all add up to this $70.5 billion. So one important source of capital is just debt, the money that Home Depot has borrowed from creditors in the market. So if you look at Home Depot's debt, there are actually two components of debt. There is the debt that is due in the next 1 year, which is about $1.4 billion. And then there is this long-term debt, which is about $35.8 billion. So of the $70.5 billion in assets, we have about maybe 37 billion or something like that from debt. So that is one source of capital. The second source of capital is equity. This is actually the money that belongs to the owners of Home Depot. How much money have the owners put up of the 70.5 billion in assets that Home Depot has? How much of it has been put up by the owners as opposed to being borrowed money or something like that? And that is this figure right here, this $3.2 billion or 3.3 billion nearly. So this $3.3 billion, that is the equity of the company. So we have $37 billion of debt and $3.3 billion in equity. That adds up to about $40 billion or thereabouts. So the remaining part, so we had 70 billion in assets and about 40 billion or something like that in equities and in equity and debt. So the remaining 30 billion roughly, that comes from things like that comes from float. And float in the case of Home Depot is basically things like accounts payable and deferred taxes and things like that, basically. So this is how the assets of the company are sort of broken down into equity, debt, and float. So I just like to understand, okay, so Home Depot as a company, it's got this much in assets. Now the second question is, okay, it's got all these assets. How much does Home Depot earn on these assets every year? And for that, you have to go to the next financial next kind of financial statement, which is basically the income statement and the cash flow statement. So, for example, this is Home Depot's income statement, and you can see that in 2020 they reported income of about $12.8 billion, or roughly $13 billion. So essentially, they had about $13 billion in income, and they earned this income on about $70 billion in assets, as we saw. So roughly speaking, they are able to earn about, let's say, 13 divided by 70 times 100. That's about 18.57%. So this is about an 18.57% return on the assets of the company. So if they have 70 billion and they're able to earn roughly 13 billion on it each year. And this is a very, very good rate of return on the assets of the company. So that is something I like to look at when analyzing a company. Then the third thing is there's this very important concept that earnings are not always the same as cash flows. So just because a company earns $1, it does not mean that the owners of the company can take $1 out of that company. So, for example, Home Depot is kind of a growing company. If you just look at the sales of the company, it's growing from in 2018 the sales were 108 billion, and then in 2019 it was 110 billion, and in 2020 it was 132 billion. So as the company keeps growing, it needs more and more in capital. So, for example, in the case of Home Depot, because the company is growing, it's selling more and more stuff, and because it has to sell more and more stuff, it needs to stock more and more stuff on its in its stores and so on, and that is inventory. So Home Depot may need more and more in inventory, and all the cash that is required to go and buy that inventory, the owners of Home Depot cannot take the cash out of the company. Because this cash is needed to go and buy inventory, which is going to be sold in the future, and so on. So there is this very important distinction between earnings and cash flows. Earnings are reported earnings are what the company makes every year, but then part of those earnings need to be reinvested back into the company. In Home Depot's case, to acquire more inventory and so on. So only the remaining can be extracted out of Home Depot by the owners or the shareholders of the company. So in order to figure out how much of this 13 billion can actually be extracted out by the owners, we have to look at the cash flow statement of Home Depot. And sorry, this is the statement of shareholders' equity. And this is the statement of cash flows. So as you can see, the statement of cash flows, it starts with this 13 billion in reported earnings that the company had. Now, it turns out that of this $13 billion, what happens is you have to calculate something called the free cash flow, or owner's earnings of this company. Free cash flow is a little simpler to calculate than owner's earnings. So the way we calculate free cash flow is simply to take the cash from operations, which is about $18.8 billion, and subtract out the capex, which is $2.4 billion. So it's like $18.8 billion is the total amount of cash that the company took in, and $2.4 billion is what the company had to reinvest back into its business. So if you take this 18.8 billion, which is provided by operations, and subtract out this 2.4 billion, you get something of the order of let me see, you get something like $16.4 billion. And this $16.4 billion is something like free cash flow for the company. So Home Depot's in Home Depot's case, the reported earnings are only $12.8 billion, but it looks like owners can actually take $16.4 billion out of the company. And for a retailer, it's actually very, very rare that cash flows exceed um, reported earnings. But in Home Depot's case, that definitely seems to be the case, at least at a very cursory glance at the financial statements. This is what seems to be the case. Now, of course, all the 16.4 billion was not given to the owners in 2020. For example, they used about $8 billion over here to go and acquire some other company. And then they used some of it to go and buy back stock in the company and so on. But the rest were given out to owners in the form of dividends and things like that. So I guess the key concept to understand here is what is the relationship between how much cash the company says it earned on its income statement and how much cash can actually be taken out of the company by the owners each year. These are the broad kinds of things I look for when going through the 10K of a company.
I love it. I love it how you tie in the story from balance sheet to income statement and then to the cash flow, and then all these numbers now make sense to someone who is listening to it, to kind of like follow the numbers, sort of like to figure out actually whether this is a strong company or not. A really, really interesting way of looking at it, and it reduces the amount of sort of intimidation these numbers have, so because you know what you're looking for. So really, really appreciate this.
Oh, thank you so much.
Well, I mean, that was really the most important reason we wanted to have you on this YouTube video today. But maybe kind of a wrap up. We're already past our like 30 minutes. So maybe we wrap up in terms of, have you ever seen, we sort of talked about companies having fraudulent, like fluffing up the numbers, but have you ever come across any crazy examples of companies actually fluffing up their numbers and fluffing up their 10Ks that you were so surprised to see in sort of like your history of like digging deep into 10Ks?
Well, so there are conservative ways of accounting for things and not so conservative ways of accounting for things. And so I don't know if it would rise to the level of fraud or anything like that, but there are often certain things in the 10K that I would probably account for in a slightly different way, and so on. So, for example, typically when you study companies that have that pay out a lot of stock-based compensation every year, what happens is there are many large companies that pay out a lot of stock-based compensation, but at the same time, they're also buying back stock. So sometimes what they say is we spent like $10 billion buying back stock this year or something like that. And then you go and look at the actual number of shares that have reduced. And the reduction in share count is definitely not what $10 billion would have bought that year. The reduction is much smaller, and that's because while they're buying back all the stock, they're also issuing stock and giving that stock to employees as stock-based compensation. Right. And things like this become fairly evident once you study the 10K. And there are several companies that do things like this. This is not fraud or anything like that, but still, when a company says we returned X dollars to shareholders, it seems a little bit like puffing up their chest and saying we returned X dollars when it's actually not X dollars that are going into shareholders' pocket,
Yeah.
and so on. So I like to generally look at the numbers and take the numbers as sort of a one data point, but also try to make broad sense of it. And if I don't quite agree with the way the company accounts for certain things, I try to substitute in my own kind of accounting for these things, just to see whether the company still makes sense to me as an investor.
That makes a lot of sense. Yeah. And I mean, especially in tech sector, what you said is specifically on stock-based compensation is that's been an issue for a long time. I think they got a lot better over the years, but at the beginning there was a lot of these sort of like a stock-based compensation challenges, sort of like hiding behind those numbers in the tech sector.
Absolutely, absolutely.
Well, we're sort of out of time. I really want to do more of this, but I want to just wrap up being respectful of your time. So if people want to find your work, we're going to put the link to it and all that good stuff, but maybe it would be better to hear from you. Where can they follow you? Where can follow your work? Where can they learn more about what you do and read your content?
Sure. If people want to follow me, the best place to do that is on Twitter. I'm available at 10K Diver on Twitter, and my DMs are open. So I try to be good about replying to DMs, but I'm not always successful because I get a lot of them. But I do try to get to reply to all the messages that I receive, although it may take a while before I do that.
Yeah, we would be. We can tell everybody that we were one of those DMs, and you were so courageous with your time and you joined on this podcast. So you're definitely one of the good ones that who respond to their DMs and actually share their knowledge openly and freely with everybody on Twitter. So we appreciate for what you do on Twitter.
Thank you so much. I appreciate it.
Thanks for doing this, and hopefully we can have you back on the show very soon.
Absolutely, would love to.